Hey, good morning, everyone. Marty Missouri here. It's the 24th of February, 2022, with a technical update for you this morning. We're going to look at stocks, ag commodities, base metals futures, gold, and silver. Jumping right in with the S&P 500 weekly chart, we'll start long term and then work our way backwards. So, folks, as I've been showing you here, we broke down below this rising wedge. We had our bearish divergences on the momentum indicators and broke through the 50-week moving average with some conviction, looks like right here. So, nothing but a bearish picture on the longer term chart for the S&P 500 as we sit here today. Zeroing in on the daily chart, remember here a couple days ago I showed this strong support line that goes back here over the past year or so, where every time the S&P came down and tested that line, folks jumped in and bought it. Well, not even close here. Yesterday you see this big red candle. Today you can see that the market actually gapped down to the bottom of the body here of this candle and is sitting currently up off of that. So we did end up intraday so far down to this level, and right now as I speak, the S&P is down about 1%, and it's been down as much as 2% on the day. But this, folks, is not a good look right here, breaking through that support. And then you have this rolling over in the momentum indicators. Now, I should point out, remember, we looked at this as a potential oversold level and an area that we might see a bounce. If we do bounce right there, we're actually going to have a bullish divergence in the RSI. And if this bounces as well and gives us a lower low, then or a higher low, I should say, then we're going to have a bullish divergence on the MACD. And suddenly the short-term picture is going to look better than it's looked in a while. And what'll be interesting to see is if we fall further from here, how we treat this level on the way back up. And allow me just to offer the huge caveat to anything that we're looking at technically that would be, that would revolve around, of course, the Russia-Ukraine situation, which is exceedingly fluid and very unfortunate as I speak. Zeroing down to the 2-hour 60-day chart, right? So each candle here is going to be a 2-hour candle. We have kind of that wedgy look, broke down below it, and we're right back into it. You could do this if you want to be more bullish on it. So falling wedge is a bullish pattern, but it really isn't for me until we have bullish divergences. So even on the short-term chart, and even though the S&P is trying desperately to stage a rally off the lows this morning, the 2-hour chart isn't giving us much to go on or much to feel very good about. Although that said, it wouldn't surprise me in the least, based on these oversold levels, to see the market come back a bit and bounce around and swing between support and resistance levels. And then we'll go to the 60-minute chart. So each candle is 1 hour, and very similar look. We're working our way back into this wedge pattern right here today. You could say you do have a positive divergence here slightly on the RSI. So, on the shorter term chart, it makes some sense and it's consistent with the swings we're seeing today. But, any of this stuff, I'll say it again for the umpteenth time over the last couple of weeks, whether you're a bull or a bear, do not hold your breath here, folks. We are going to see big price swings in both directions, daily, weekly, maybe even monthly, certainly on an intraday basis. Okay, update on the NASDAQ Composite Index. It's actually moving into positive territory today. Interesting. So we had this huge gap lower, like 2 or 3% at the open, and then it's gapping up. Okay, so I think I can safely say that we can attribute that to the market anticipating that perhaps based on what we see happening in Europe, that it could actually be something that stays the hands of central banks, the Fed in particular, going forward for a while, right? In March, the Fed has made it very clear that they're going to raise the Fed funds rate at least 0.25%, and they're going to stop doing their asset purchases. Inflation indicators and political pressure, I should say, demand that they begin doing something about inflation. Well, a global economic weight, like perhaps what's going on in Europe, could actually, do some of the Fed's job by itself, right? If the global economy slows in kind of reflexive action based on what's going on in Ukraine and Russia, and people draw in and spend less money, well, then that would have a negative impact, meaning on inflation, meaning inflation could come down. And just the overall geopolitical concerns might justify, the Fed to say, hey, let's just kind of wait and see how this plays out. Tech stocks, which largely dominate the NASDAQ composite, are very interest rate sensitive, and they've had quite the brutal correction over the span of the last several weeks. And so anything that would suggest that maybe the economy might slow down and maybe interest rates won't go up and inflation won't be here like many of us anticipate, or like we've seen, I should say, then that would be bullish for tech stocks, and we'd get a boost from tech. Now, having said all that, look at where this is happening and look at the impact on commodities, or look at the exposure, both agricultural commodities and particularly energy and so forth, could do a real number on supply chains for those commodities, and therefore could push the price higher and exacerbate the whole inflationary picture. For the moment, for today, I can tell you that tech stocks are discounting a somewhat of an alleviation of the pressure on the Fed to do anything come next month. Time will tell. Very, very, very fluid, very volatile circumstances for sure in just about every respect right now. Speaking of agricultural commodities, this is the ETF we use. This is a not small position for us, and we started this fund, or we bought this fund back in September of 2020, so less than 2 years, and we're very glad that we took that position. It made a lot of sense to us at the time. It's up over 50% since we bought it. So clients, I know the K1 forms aren't much fun. These two funds that we have, I'm going to talk about the base metals fund. They're tax-like partnerships because they invest in futures. And, not every accountant likes to mess with K1s, but we do this from time to time, or we have over the decades, when we find compelling bullish reasons to own a fund that would deliver a K1. Technically speaking, it looks pretty good. Looks like it's consolidating here right near these highs. We did gap up this morning, but we've fallen back below that. So, resisting this high right here, technically speaking, there's nothing that really concerns us necessarily. You could say that's a little concerning. And when you go longer term, you would say that that's a negative divergence off of relative to these highs. Fundamentally, we think it makes a lot of sense to be in ag definitely for the foreseeable future. Will we take some off the table at some point? Yeah, I think we probably will during the course of this year, either sooner or later. But for the moment and longer term, we think it'll be a good core position for us. Base metals futures, I've spoken and written volumes herein about copper and our bullishness around copper for many years to come. This one we added at the same time back in September of 2020. It's up almost 80% since we bought it. Right now, it's flirting with this high right here as potential resistance. Similar look here. You could definitely say there's some weakness potential in the charts when we look at the daily chart. Longer term, we like it a lot. And then just want to update you on gold. Having a good morning this morning, gapped up above what I said might be this resistance line that people might want to short based on what we're seeing here. However, with the news in Europe, we got a nice pop, and this is where it gapped to this morning. This is where it currently sits. We'll see if it holds this level. I could certainly see some weakness in gold, particularly as geopolitical circumstances begin to calm down. Again, we'll see. We're hedged at about 20% below the current price with a put option. So, we're subject to some pretty good short-term downside in gold. Again, another position that we'll manage as we go. But given our longer-term thesis about where interest rates really can't go, given the overall debt composition, particularly in the U.S., gold makes a lot of sense right here, but it'll come with some big, fits and starts along the way. And then lastly, silver. So the other day we did the silver analysis and we were right back down in here, and I said this looked pretty compelling. Sure enough, we've broken through the 200-day moving average, but we are finding resistance right at our resistance line right here, and we're failing that, at least as we speak here this morning. I do believe that this is set up to be pretty strong resistance. In fact, let's just spend a minute on that, and then I'll let you go. So retracements are good things to draw when you get big price moves in an asset. So let's take a look at the retracements off of the high for our silver ETF right here. So here's the high, and then here's the low, right? So typically, when you're in this case in a near-term downtrend, as you retrace, you tend to run into resistance at certain levels. The key levels are 38.2, 50%, and 61.8%. And these are retracements off the bottom back toward the top. 50% being very key. But notice that after we hit the bottom, we came up, kind of broke through the 38% retracement and then lost it just before the 50. Came back down, tried to hold, battled it here, lost it again at the 50% retracement, came back up 30. So these are just key levels. So if you're swing trading silver, these retracement levels would have really helped out a lot. Swing trading means just buying and selling as you find a range. Well, the 50% retracement, which is big, happens to fall almost on top of this resistance line that it shows right here in this price. It actually goes back, right, further than that. So yeah, you got double resistance right there. So again, this would be, I think, a really smart short for short-term traders who are, very nimble and very quick and want to trade this. That's not what we do, of course, folks, on behalf of our clients. So that's not where we are. But this is just, something to look at. Longer term, think about silver. It's a very important industrial metal. It's in every solar panel made, right? Has to be. It's a key ingredient. And it's got that precious metal quality, which plays into our longer term thesis as well. So long term, we like silver a lot. We will manage it, of course, as we go. And we'll have periods where it really helps our relative performance, like it has in a big way so far this year, relative to what most people in firms, not us necessarily, but what most people benchmark against, like the S&P 500. Commodities have helped us a lot this year, but we're going to go through stretches where they don't, relative to those benchmarks. But that's not our goal here. Our goal is to deliver, solid, long-term, risk-adjusted results. And the key there, folks, in this world is, risk-adjusted. But there's going to be days, like most of the days this year, where our relative moves to the stock market have been very positive. Today, I'm sure, because our foreign exposure is taking such a hit, that we're probably capturing most of what the S&P 500 is delivering to the downside. Having said that, though, we are hedging the big moves with options, right? Remember that 35% dip in 2020, we caught, just a fraction of that overall because of those options hedges. But that's when they really come into play, is on the bigger moves. I will say, though, that we did have a nice, and still do, a nice hedge on our foreign exposure that was closer to the money. So this morning with that big dip, Nick was able to roll that out to April and literally take a very nice profit on that particular hedge and basically move it down a little bit, but still pretty close to where foreign stocks are trading. So it still gives us meaningful protection, but essentially it just paid for itself. And that's the ideal scenario as we manage these hedges going forward. So folks, I've rambled long enough. I'll stop there. Thank you as always for watching and listening, and stay tuned. I'll be back with much more to come. Take care. Bye-bye.